There are three types of financial statements: balance sheets, income statements, and cash flow statements. I want to talk briefly about what a balance sheet is. A company will have certain assets that are funded by money that's coming from providers of capital, either in the form of equity or debt. And the balance sheet captures how that happens and how that looks. And in its most simple form, a balance sheet balances. And what it shows is, on the left side, it shows all the assets of the company, and on the right side, it shows where that money came from, either in the form of equity or debt. So on the left side, on the asset side, we would see all the things that the company has: factories, buildings, machinery, cash, securities, anything like that. And on the right side, we would see all of the debt of the company, whether it's long-term debt, short-term debt, and we would also see the equity of the company, i.e. the ownership interest. And we know that if we take all the money that was lent to the company and all of the ownership capital that was put into the company, that would equal the value of the assets. And that's why balance sheets balance, and that's why it's called a balance sheet. And a balance sheet is a snapshot for that company at a point in time. Assets on the left side and the sources of funding on the right side, and it balances. And that's all a balance sheet is. And we can see that, and what happens over time is that as the assets go up or down, the right side also goes up or down. And typically it's the equity that goes up or down, because the debt doesn't really change. So if the assets of a company go up greatly, the amount of money that they borrowed wouldn't have really changed, and it really affects what the equity of the company is, and how the equity of the company would move up and down correspondingly.